Ever since Trump's tariff threats began, everyone has been trying to figure out how they will impact the economy. Will there be inflation? Will there be a recession? Or could stagflation be the outcome? A recent report by one of the world's largest asset managers may have found the answers.
And, spoiler alert,
they're not good. In fact, they suggest that a recession could be imminent. And that's why today we're going to summarize this report and tell you what it could mean for the economy, for the markets, and for you. My name is Nick, and make no mistake, this is a video you can't afford to miss. The report we'll be summarizing today is titled, quote, "How are US consumers and firms responding to tariffs?" It was recently published by Apollo Global Asset Management, and we'll leave a link to the full report down in the description for you. You'll notice it's more like a compilation of data than a report per se. Thankfully, Torsten Slok, the head author of the report, recently did an interview where he talked in detail about many of the infographics included in the report. More importantly, he provided additional nuances that's not included in this document itself. We'll leave a full link to that interview down in the description as well for you to come back and watch later. Now, the report begins with a few quotes from the CEOs of Southwest Airlines, Chipotle, and PepsiCo. As you might have guessed, they paint a pretty bleak picture. The one from the Southwest Airlines CEO probably hits home the hardest. Quote, "I don't care if you call it a recession or not. In this industry, that's a recession." Then the report lays out a flowchart which basically shows when a recession will be in the US and why. And what's fascinating is that the infographic is titled, quote, "The Voluntary Trade Recession." Logically, this implies that Trump intentionally caused a recession, which is something many have speculated about. More about that in the description. Now, as you can see, Torsten expects the US economy to enter a recession by the summer, and this is based on the flow of goods. The catch is that he doesn't specify what he means by recession, neither in the report nor in the recent interview. Even so, it's clear that at this point, the US is headed for a technical recession. As some of you will know, a technical recession is 2 quarters of declining GDP, and it's only declared by the National Bureau of Economic Research after it happens. And, as some of you may have heard, Q1 GDP came in negative, and chances are that Q2 will look the same. We will only really find out by the end of July, which happens to be over the summer. In the interim, the flowchart notes that by the end of May, there will be, quote, "empty shelves." Now, to our understanding, Torsten doesn't mean that there will be a shortage of goods, but a drop in consumption that causes retailers to stop stocking certain products. And this is because the next slide notes that retailers have been stockpiling inventories ahead of the tariffs, which presumably means more supply. I'd also be remiss if I didn't mention Torsten's more immediate prediction, and that's that the activity at US ports will grind to a halt by early to mid-May. Besides the fact that most of the tariffs could be resolved by then, Torsten did not address this halt in activity in his recent interview. In fact, he specified that the economic impact of the tariffs will depend on their magnitude and duration, which are still unknown. Most importantly, Torsten stressed that if the tariffs on China are not as severe as the ones Trump proudly presented after Liberation Day, then he believes many of the adverse market effects we've seen would be quickly reversed because the US continues to be, quote, "the most dynamic and exceptional economy in the world." But obviously, that optimism won't make for good headlines. And by the way, guys, if you're enjoying this video so far, then smash that like button to let us know and subscribe to the most dynamic and exceptional YouTube channel in the world while you're at it. Now, Torsten highlights the fact that there has been a sharp decline in earnings outlooks among the S&P 500 companies that's comparable to the pandemic. Of course, a change in earnings outlook does not mean that there will necessarily be a change in earnings. It's essentially a change in sentiment. However, the same cannot be said for the data about new orders of goods by retailers. As you can see, new orders are clearly collapsing, and this is true regardless of the indicator you use. Notably, you'll notice that there was a surge in new orders at the start of the year. Now, that's the increase in inventories ahead of the tariffs, which we'll come to in a second. First, we need to look at the more concrete data, and that's the sharp decline in corporate spending plans. Fortunately, all these indicators are still within normal range. Unfortunately, it looks like this is going to change in the coming months. as the trend is indeed clear. Corporates are pulling back on their spending. If that wasn't bad enough, various indicators of prices being paid by manufacturers reveal that we're seeing a huge run-up in costs comparable to the start of the pandemic. At first glance, you'd think this means that inflation is about to skyrocket. But upon closer inspection, however, the aforementioned increase in inventories suggests we could actually see goods deflation in the short term. Torsten provides multiple infographics in the report showing how inventories have skyrocketed in recent months, and there's one thing they all have in common. They've all surged to levels last seen at the end of the pandemic. And this is interesting, as you'll understand why if you remember what happened back then. To refresh your memory, the pandemic restrictions meant that nobody could spend money on services. The result was a massive surge in goods consumption and surge in goods-related inflation. Eventually, the pandemic restrictions went away, resulting in a surge in services-related inflation. At the same time, goods inflation collapsed because retailers stockpiled lots of goods in response to the pandemic demand. The data in Torsten's report suggests we could see a similar phenomenon, but for different reasons. At this time, retailers have been stockpiling goods ahead of the tariffs, but consumers have been reducing their consumption per the quotes of the CEOs we looked at earlier, and the consumer data we'll look at a bit later. The effect of this increase in supply and decrease in demand could be a drop in goods inflation in the short term. At the same time, services inflation could also fall because of the reduction in consumption, as well as the crackdown on illegal migration, which has supposedly been keeping housing costs high for quite some time. Now, for context, housing costs have been the biggest contributor to inflation in recent months. As it so happens, goods and housing each make up 1/3 of the CPI, meaning they collectively amount for 2/3 of the CPI measure. Sprinkle in a sharp decline in oil prices and you have a recipe for a sharp decline in inflation in the coming months. The caveat, though, is that this will be accompanied by a sharp decline in economic growth, and this is presumably why Torsten is foreshadowing recession and not stagflation.
Oh, I didn't see you there. Well, now that I've got you, I may as well let you know about the Coin Bureau deals page. It's over there where you'll get $100,000 sign-up bonuses on the best exchanges in crypto, as well as 60% trading fee discounts on said exchanges. And you can also get discounts on hardware wallets. All of that in the Coin Bureau deals page down below in the description. Now you go back to the video, I'm going back to chillaxing.
On that note, Torsten underscores the sharp decline in economic growth we're likely to see with a bunch of eye-opening indicators. First, heavy truck sales, which are collapsing. Now, for reference, almost 3/4 of all goods in the US are moved by trucks. A decline in truck sales means less goods moving. The good news is that the heavy truck sales are still within normal range for this time of year. The same is true for the Logistics Managers Index, which keeps track of logistics activity across the US. In this case, the concerning thing is that the index never really recovered after the pandemic, and this is one of the many data points that suggest the economy didn't really recover as much as we've been led to believe. Torsten also looks at a few charts related to trade between China and the US, which makes sense given that China appears to be the primary target of Trump's tariffs and is also America's biggest trading partner after Canada and Mexico. Two charts show a surge in container ships departing China for the US in February, March, and April, which is consistent with the surge in inventories we looked at earlier. The third chart shows something that nobody has been talking about, and that's the collapse in container freight rates. And if this sounds familiar, that's because container freight rates were a big talking point among macro analysts during the pandemic. The surge in goods demand we discussed earlier caused a surge in shipping costs, but again, these shipping costs recently started collapsing. Speaking of which, there's a big misconception about tariffs that need to be addressed. Most people think that a 10% tariff on, say, an iPhone means that the price of the iPhone will rise by 10%. This is not accurate. It means that Apple will have to pay an extra 10% when it imports the iPhone from China. As a fun little fact, iPhones cost Apple around $500 to produce, and it's extremely important to note that most of these costs are not related to manufacturing, which apparently cost as little as $30. Considering that iPhones sell for around $1,000 each, this means Apple makes a 40 to 50% profit. For the sake of simplicity, let's say that Apple has to pay a 20% tariff on iPhones imported from China, and that increases the cost of production from $500 to $600. Some economists would argue that in these circumstances, Apple would pass on the cost to consumers, meaning prices would rise by $100. However, this assumes that corporates have the capacity to pass on these costs to consumers. In other words, it assumes that the consumer is doing fine and will continue to pay that cost. As we learned earlier, however, consumers are not doing fine, and they have been cutting back on spending as a result. And this means that it's going to be very hard for corporations to pass on the costs of tariffs to consumers. And that means most corporations will have to keep costs where they are and reduce their profits. As it so happens, this is exactly what Walmart recently said it would do, keep costs for consumers where they are to gain market share. Funnily enough, though, Walmart is going to pass these costs on, but to their suppliers. As it so happens, the second part of the report focuses on the consumer. Not surprisingly, consumer confidence is at record low levels, and tourism has also slowed. What is surprising, though, is that consumers have also been on a buying spree ahead of the tariffs, which could contribute to short-term deflation. But first, the sentiment. What's crazy is that consumer sentiment is literally at record lows, even lower than the levels seen after the 2008 financial crisis. And what's even crazier is that consumer sentiment has been on the decline since the pandemic and never recovered, further evidence of the fake economic recovery. And this might have to do with the next indicator, which is rising concerns around unemployment. More and more people are concerned about losing their jobs. However, restrictions on immigration could mean that companies are more and more concerned about not getting employees back after they fire them. And the result could be another paradox, and that's that companies trying their best not to fire people. And that reminds me, another variable that many economists seem to miss is the rise in the gig economy and its impact on unemployment. Now, for those who don't know, unemployment measures how many people are looking for work but can't find any. Many people who lose their jobs choose to do gig work rather than to file an unemployment claim, which could also result in artificially low unemployment data. I'd also be remiss if I didn't address the elephant in the room, and that's all the government layoffs from Doge. Now, Torsten mentioned in his recent interview that 280,000 people had been laid off by Doge. In theory, this means unemployment is about to spike. In practice, however, those laid off by Doge will reportedly continue being paid until September 30th, so they won't show up in the unemployment figures anytime soon. In any case, as you might have guessed, the report includes a statistic that's been recently going quite viral, and that's the rise in consumer expectations around inflation. And if you've heard about this data, chances are you've also heard about how a lot of it is based on how people lean politically. Meanwhile, actual inflation has been falling faster than expected because of the supply-demand dynamics I mentioned earlier. Regardless, Torsten looks at another viral statistic, and that's the sharp drop in travel from the rest of the world to the US. It's quite remarkable, really. Travel to the US has declined by as much as 30% from some countries, and the number of tourists arriving by the air has likewise fallen by as much as 30%. Perhaps we're mistaken, but this drop in travel is also probably related to politics rather than the tariffs. The data around the share of credit card accounts making the minimum payments, however, is definitely not, nor is the data around the delinquency rates on these credit cards. On the one hand, both numbers are still objectively low, 11% and 1% respectively. On the other hand, however, both are clearly on a strong uptrend, and this foreshadows more stress among consumers in the coming months. Torsten seems to contrast this data with the number of tourists visiting Las Vegas, as well as the occupancy rates of Vegas hotels. Now, both have actually held quite steady, which actually makes sense. Now, for those unaware, gambling behavior tends to remain robust regardless of economic conditions. And there's actually data that suggests gambling will increase during hard times as people effectively gamble to try and get ahead. And that's why it's a bit strange that the weekly demand for hotels in general has remained relatively steady, especially considering the recent drop in international travel and tourism. What's not strange, though, is that there's been a decline in the number of cash purchases of homes. The chances are that it's usually investors who do this kind of stuff, and the recent crash in the markets has investors pulling back from cash purchases. Torsten then presents an infographic that showcases just how reliant the US stock market is on China, with exponentially more revenue from the S&P 500 coming from China compared to US exports to China. And this is presumably intended to give the reader the impression that the US can't put any significant tariffs on China without them backfiring. Finally, Torsten presents this matrix of outcomes with the title saying it all. Quote, "A trade war is a stagflation shock." There's no question about that, but it is questionable as to whether the US has entered a full-blown trade war just yet. You'll also recall that Torsten said the US could quickly rebound from these tariffs if they're scaled back. In fact, the report appears to present a significantly more bearish picture for the economy and the markets compared to the interview Torsten did about the same data just 2 days later. And this makes us wonder whether the co-authors of the report have had a role in moving it off of the mark. Whatever the case, you'll remember that Torsten stressed that if the tariffs on China are reduced, then most of the bad stuff is likely to go away. However, he warned that if they stay at their current levels, then there is a 90% chance of recession starting by the summer. Not stagflation, recession. To put things into perspective, Torsten believes that the worst-case scenario on the inflation side would be a personal consumption expenditures index, or PCE, to rise by 1% over the next year, and it's currently around 2%. Perhaps we're mistaken, but inflation in the low 3% range isn't exactly stagflationary. Torsten also stressed that the increase in inflation ultimately depends on whether retailers can pass on these costs to consumers. If the economy is weakening and consumption is falling, retailers will have to eat the cost as additional expenses, and you'll recall, we're already starting to see early signs of that happening. I'd also remind you that Torsten said that the US economy was, quote, "still the most dynamic and exceptional economy in the world, despite the tariffs." He even said that he hasn't seen any signs of anything in the market breaking, even the recent stress in the bond market. It's in stark contrast to what's in the report, which again leads us to believe that it could have been the co-authors having a hand in things or just clickbait. And this brings me to the big question, and that's what this report means for the economy, for the markets, and for you. The answer to all of the above fundamentally depends on the final tariffs, particularly the final tariffs on China. As Torsten himself pointed out, we've already seen China and the US introduce multiple exemptions, which suggests that the most important goods may not be affected by tariffs at all. However, it's clear that tariff threats have done serious damage to both corporate and consumer confidence. Although this hasn't translated into much concrete data yet, the Q1 GDP data that recently came out suggests we will get the recession Torsten foreshadows in the report. However, it could be argued that the economy has been weak for a long time, and I'll reiterate that many of these indicators, such as consumer confidence, has been falling since the pandemic and has never really recovered. Given this fact, any further weakening due to tariff concerns could in fact be the thing that tips the US economy into a recession, and it looks like that's exactly what's going on. But again, this is not something that would be officially declared until long after the fact. While there are many unofficial indicators of economic recession, they all continue to provide a mixed picture. Some say that a recession is coming, others say that a recession is already here, and I'll repeat that unemployment is likely to be kept artificially low in the coming months due to gig work and Doge severance payments. The consequence for the economy could therefore be more chop and grind, just like what we've seen in the markets in recent weeks. Both could continue to chop and grind until tariffs are finalized, and both could see short-term periods of growth once that happens. But the underlying weakness will likely remain. How it impacts you really depends on your personal circumstances. Unless you work in an industry that's known for laying people off at the slightest hint of economic weakness, like hospitality, then you're probably fine. And if you work in such industries, you probably already know what you're in for. At the same time, the prices of most goods could actually fall as retailers swallow any tariff-related costs to try and gain market share or to keep market share like Walmart. It sounds like traveling is going to get a lot cheaper too, and sprinkle in continued decline in oil prices due to OPEC's upcoming production increase, and all of a sudden the inflation picture doesn't look nearly as bad as expected. But make no mistake, things could go very wrong very quickly. We could in fact see supply chain issues and empty shelves if the trade threats escalate into a full-blown trade war. Thankfully, this hasn't happened yet, and with a bit of luck, the situation will continue to de-escalate in the coming weeks and months. Whatever happens, you can bet that politicians will trade every swing in the market before it happens, and you can learn more about that watching our video right over here. And if you're not subscribed to the channel yet, you can do that right over here. That's me for now. Thank you very much for watching, and I'll see you guys again soon.